beating the markets is what everybody wants to do. And since 2019, my next guest, Joe Hagan, the CEO of Wealth Colony, has been coming on the show and talking about Datadog, and the stock is like doubled. I don't even know where it is today. I didn't look at it, Joe, but you've been on that thing from day one. Well, give us a little update in that area.
So yeah, Datadog actually is one of those days that if you're thinking of buying it, today's a perfect day. Just like one of the last times I was on your show, I said, hey, it hit 98. Look for a pullback. It pulled back to 85. Great way to jump in. It retraced all the way back to 95 yesterday. Today it's back down 6. It's a day like today is a buyer's day for Datadog. It's up close to 200% in the 9 or 10 months since we've been talking about it, and I think it's got more room to go.
All right. Well, we'll keep our eye on that. And I mean, we just had on Chris Carter, is the CEO of Aproyo, and we were talking about the Internet of Things. And I mean, just every single day we're getting closer and closer to this big data society. It's where everything is going. But Joe, the markets are crazy. The market's doing okay today, up 30 in the 27,000 range. But I see a lot of volatility with the COVID, with the election. And, you know, some people think they missed the run. Other people think it's going to tank again and there'll be a buying opportunity. But the volatility, the big swings, they give people heartburn. They give people agita. I wanted to talk to you today about, you know, in a time when interest rates are so low, non-correlated investments. And I will just disclaim it by saying both Joe and I are shareholders in InvestView. We both have worked for a subsidiary of InvestView called Apex. So we do have a dog in the fight. But tell people about non-correlated and income production a little bit, Joe.
Yeah, sure. So like you just described, who wants more wrinkles ahead of time by having all of your retirement money and more stress overexposed in the market? You know, I love the stock market, but I don't think there should be overexposure. I think a lot of people are really interested in non-correlated, meaning your funds are not in the market. They're not subject to the volatility of the next pandemic, of the next geopolitical event, an election, you know, a war, a bomb going off, whatever. So more and more people want that, you know, want some sense of security, but they want that passive income. And, you know, I've done a webinar on one of the companies that I help people understand when they have money in a 401k or an IRA. Traditionally, they can move it into a self-directed IRA, and they could buy real estate. They could buy what we do with data mining equipment. They could buy that and lease it out for someone who really knows how to use that equipment and monetize that. And in return, they can turn around and get 20% a year. So when you take, right, just a traditional IRA or 401k that's in a diversified portfolio, it's making 6% a year. So say you have 150 grand in a diversified portfolio making 6% a year. At 5 years, that'll be worth 200 grand. Okay. If you have that same portfolio making 20% a year for 5 years, it'll be worth 300 grand, not 200 grand. So you're making an extra 100,000. And with an insurance policy, you have protection of principal, right? So you don't have that in the stock market. So it's a way to really smartly move some of, if not a lot of your money from the volatility of the market into an investment that's asset-backed, has protection, and is paying you or your self-directed IRA directly. And I've given a quote or a stat, I should say, John, once before. We're not alone in identifying this. It's very popular. Price Waterhouse recently put out a report that since 2018 to 2020, there's been 60% growth in alternative asset-backed investing. The market is up to 15 trillion.
Wow.
So, yeah. So Forbes wrote an article that said you should have at least 30% of your portfolio in an alternative asset-backed investment. And if you're really conservative, 20%. So, you know, we're not alone in recognizing it's a smart way to really improve your portfolio, and also, you know, make it more volatility proof, you know, from the market swings. And that's what non-correlated means.
Right. So, you know, just a crib note on that. Non-correlated is you're buying something, it has a dividend, and it's not going to be subject to the swings of the market because it's worth whatever its income generation will be. So they're kind of stable. Joe, InvestView made a nice announcement on the preferred offering, and it's public now. I know we've known about it a little while the preparation was going on. This press release just came out today that InvestView pays their preferred quarterly dividend. So they paid the quarterly dividend to preferred shareholders of 81 cents per share on June 30th. To all holders of preferred shares as shown on the transfer records of the company. So this product, the InvestView Preferred, publicly traded, new class of stock, they talked about it. They said they were going to do it. Now they're doing it, paying 13% a year. So if you're interested and want to know more about how you can get 13% a year, you got a whole team waiting there, right, Joe?
Yeah, I mean, we have agents. Book an appointment at calendly.com/wealthcolony. And so run it by you real quick. We'll show you how to do it directly without a middleman and commissions and everything else. But, I like saying non-correlated to the market. In this case, technically, InvestView is a preferred share, the INVUP that'll trade, in the market. But literally all of 3 years of interest are sitting in escrow waiting to pay you. And you're also going to get some comments. So don't forget, the reason why smart institutions love these deals is they're going to get their return 13%. If you had, I don't know, $1,000, $5,000, $100,000, whatever you're comfortable with, you have that sitting in a bank. If you own the preferred for the last quarter, you just made 3.25%. That's more than if you had in the bank for more than a year. No one's paying 3%. I think even on CDs, right? So you can get your return, okay, and you get additional extra common shares thrown into the deal, which on the 13% can add up to another 25, 50, 100%, depending on how high that stock goes. But that stock, that risk is mitigated by the fact that you own the preferred, the interest payments are sitting in an escrow account for the next 3 years, and the common, I like to call it, is gravy. So that's a smart way to approach it.
All right, well, at least we're on the same page on that, too. I call it gravy, too, not sauce. But, Joe, thanks so much for joining us today. You guys out there, if you want to know some more about how you can add alternative investments and passive income to your portfolio or your self-directed IRA, you got to go to wealthcolony.com. Reach out to Joe. We're friends for years. He'll treat you like family. And you can always reach out to me, too. Joe Hagan, thanks a lot, brother.
Thank you, John.